The fall of Silicon Valley Bank.
Second biggest bank collapse in U.S. history.
It is the epicenter of tech startups, venture capital, Silicon Valley Bank. It is the 16th largest bank, or it was, in the United States.
The collapsed bank had invested in around 21 Indian startups.
The bank stock lost 80% of its value this week, 60% in one day alone.
The management of these banks will be fired. Investors in the banks will not be protected.
It all started with Silvergate Bank, a crypto-friendly lender that collapsed earlier this month after losing deposits from its clients who withdrew cash to weather the collapse of FTX, a digital asset exchange. Silvergate announced plans to wind down operations and liquidate its assets, leaving many crypto ventures scrambling to find alternative banking partners. Then came the Silicon Valley Bank, the 16th largest bank in the United States, which also failed last week due to risky investments and rising global interest rates that eroded the value of its bond holdings. The bank had a large exposure to venture capital firms and startups that were hit hard by the market turmoil. The Federal Reserve stepped in to provide emergency funding and facilitate an orderly resolution of SVB's assets. But the worst is yet to come. Credit Suisse, one of Europe's biggest banks, saw its shares plunge to record lows this week as it faced a string of scandals and losses that threatened its survival. The bank has been involved in money laundering charges, corruption cases, spying incidents, and data leaks in recent years. Alexander David Lex Greensville, CBE, born on the 29th of December 1976, is an Australian businessman best known for being the founder of Greensville Capital, a company focused on supply chain finance and derivative financial products that on the 8th of March of 2021 filed for insolvency protection and faced legal scrutiny. It also suffered huge losses from its ties to disgraced financer Lex Greensill and failed investment firm Archegos Capital Management IV. Credit Suisse had to borrow up to $54 billion from Switzerland's central bank to shore up market confidence, but many analysts doubt it can recover from this crisis. These bank failures have raised questions about the stability and regulation of the global banking system. How did these banks get into so much trouble? What are the implications for their customers, creditors, and shareholders? And what can be done to prevent another banking crisis? Join us on a journey of discovery as we delve into the fascinating world of finance and uncover the mysteries surrounding the fall of Silicon Valley Bank. In this video, we will embark on a quest to answer the burning questions that have arisen from this dramatic event. We will immerse ourselves in a world of financial analysis and expert commentary as we explore the intricacies of this complex and fascinating story. Our focus will remain unwavering as we delve into the heart of the matter and unravel the many threads that make up this intricate tale. From the regulatory gaps and weaknesses that were exposed to the investigations into insider trading and conflicts of interest, we will leave no stone unturned as we piece together the events that led to the fall of Silicon Valley Bank. The catastrophic collapse of Silicon Valley Bank sent shockwaves throughout the United States financial landscape and the technology sector, leaving many stunned and bewildered. On the fateful day of March 10, 2023, the once mighty financial institution was abruptly shattered by federal regulators, marking a dramatic turn of events that would forever alter the course of its history. The bank, once a beacon of stability and prosperity, was now placed under receivership, marking the beginning of a long and uncertain journey towards resolution and recovery. The fall of Silicon Valley Bank was not just an ordinary financial event, but a seminal moment that would have far-reaching consequences and ripple effects felt across the entire country and beyond. The once thriving financial behemoth, Silicon Valley Bank, was suddenly bested by a tumultuous storm of financial turmoil and instability that ultimately led to its downfall. The root cause of this catastrophic chain of events was a sudden bank run, which was triggered by a confluence of several factors that converged to create the perfect storm of financial instability. The bank had been facing mounting challenges and pressures from both within and outside its walls that slowly but surely eroded its once solid foundation in strength and resilience. The capital crisis that followed was a testament to the severity of the situation, as the bank struggled to stay afloat amidst a rising tide of panic and uncertainty. Despite the valiant efforts of its leadership and employees, the bank was unable to weather the storm and eventually succumbed to the overwhelming forces arrayed against it. The fall of Silicon Valley Bank was a stark reminder of the fragility and volatility of the financial system and the need for constant vigilance and preparedness in the face of uncertainty. The impact of interest rates. The downfall of Silicon Valley Bank can be traced back to a multitude of factors, but one of the most prominent and influential factors was the Federal Reserve's decision to raise interest rates over the past year in an effort to combat inflation. Interest rates, as we all know, are a crucial metric in determining the cost of borrowing money. When interest rates are low, borrowing money becomes relatively cheap, which can turn into stimulate economic growth by encouraging people to spend more and invest more. However, this can also result in inflation, which is a persistent increase in prices over time and can erode the purchasing power of consumers. The Federal Reserve, being the central bank of the United States, holds immense power over the financial system and economy, with the ability to influence interest rates by setting a target range for federal funds rate. This is the rate at which banks lend money to each other overnight and can be adjusted by the Fed by buying or selling government bonds in the open market. The Fed took the decision to raise interest rates last year due to the rapid rise in inflation, which was outpacing its 2% annual target. The aim was to slow down inflation by making borrowing more expensive and reducing damage in the economy. This year alone, the Fed has raised interest rates 6 times, resulting in a cumulative increase of 3 percentage points. The bond portfolio debacle, another major factor that contributed to its failure, was its heavy investment in long-term bonds that lost the value as interest rates rose. Bonds, as we know, are fixed income securities that offer a regular interest rate to investors who lend money to governments or corporations for a specified period of time. The price of bonds and interest rates have an inverse relationship, meaning that when interest rates rise, bond prices fall, and vice versa. Silicon Valley Bank had made significant investment in long-term bonds, primarily US Treasuries, when interest rates were low before 2022. These bonds had a low yield during a long duration, which made the bank vulnerable to interest rate changes. As the Federal Reserve raised interest rates in 2022, the value of Silicon Valley Bank's bond portfolio began to decline rapidly, leading to a significant loss of $1.8 billion. To mitigate the impact of this loss and meet its customers' withdrawals, Silicon Valley Bank made the decision to sell its $21 billion bond portfolio on March 8th of 2023. The failed capital raise. The final piece of the puzzle in the downfall of Silicon Valley Bank was the collapse of its plan to raise $2.25 billion in equity and a convertible stock, which was announced on March 9th, 2023. Equity and convertible stock are both forms of securities that represent ownership in a company, with equity being common stock that offers voting rights and dividends, and convertible stock being the preferred stock that offers a priority in receiving dividends and assets in case of liquidation, and can also be converted into common stock at a predetermined ratio. Silicon Valley Bank had taken the decision to raise its capital through the issuance of equity and convertible stock after it reported a staggering $1.8 billion loss on its bond portfolio sale. The aim was to replenish its capital and restore confidence among depositors and investors, and the bank had hired Goldman Sachs Group Inc. as its advisor for the deal. Unfortunately, the deal was unable to attract enough buyers, as the bank's financial situation rapidly worsened. Some of its clients, particularly tech startups backed by venture capital firms, chose to withdraw the money from the bank after receiving warnings from their investors about the bank's solvency risk. Bleak future for the tech industry. The collapse of SVB had widespread implications for the tech sector and the economy. The collapse of Silicon Valley Bank had far-reaching implications for the tech industry, as many tech startups suddenly lost access to their funds and faced uncertainty about their future. The sudden interruption of their financial lifeline had a profound effect on the innovation and growth of the tech sector, which relies heavily on funding the banking services from Silicon Valley Bank. As a result, many tech startups were left in a precarious position as they scrambled to pay their employees and keep their operations running. Some startups were forced to pause their projects, lay off workers, or make other difficult decisions to survive as they waited for the Federal Deposit Insurance Corporation, FDIC, to process their claims and release their funds. The uncertainty and anxiety associated with the collapse of Silicon Valley Bank had a profound impact on the morale and motivation of employees from these startups, as well as on their overall financial stability. The fallout from collapse of the Silicon Valley Bank also had a negative impact on the competitiveness and profitability of the tech sector in the long run. The investment and financial sector takes a hit. The collapse of the Silicon Valley Bank also had implications for the investment and financial sector, which had established ties to the bank as a lender or borrower. Many private equity firms and hedge funds that invested in the bank suffered against significant losses or faced liquidity problems as a result of the bank's failure. These private equity firms and hedge funds had invested in the equity or debt securities of Silicon Valley Bank, which became worthless or illiquid after the bank's collapse. Additionally, many private equity firms and hedge funds relied on Silicon Valley Bank for financing their deals or managing their cash flows, and as a result were forced to find alternative sources or funding to liquidate some of their positions to meet their obligations. The impact of the collapse of the Silicon Valley Bank on the investment and financial sector was twofold. Firstly, the losses and liquidity problems faced by private equity firms and hedge funds could affect their returns and performance in the short term, which could have a ripple effect on the broader economy and the financial system. Secondly, the difficulty in assessing funding and managing cash flows could impact the ability of these firms to make new investments and grow their portfolios, which could have long-term impact on the competitiveness and the profitability of the investment and financial sector. The impact on depositors, creditors, and the banking system. The collapse of Silicon Valley Bank had a profound impact on the customers and creditors of the bank as well, who had claims on its assets or liabilities. In the wake of the bank's failure, the Federal Deposit Insurance Corporation, FDIC, stepped in as the receiver of the failed bank and assumed control of its assets and liabilities, as the FDIC's role to maximize the value of the failed bank's assets for the benefit of depositors and creditors. It is said that they would try to sell the assets of Silicon Valley Bank and pay back uninsured depositors over time. However, this process is not without its challenges, and the FDIC may face a number of difficulties as it tries to execute this plan. Firstly, the process of selling the assets of a large and complex bank like Silicon Valley Bank can be complicated and lengthy, and the FDIC may face challenges in finding buyers for the bank's assets, which include loans to tech startups, venture capital funds, and private equity firms. Secondly, the FDIC also may face legal challenges from its uninsured depositors and creditors who may dispute the amount or priority of their claims. The result of this complex and uncertain process is the uninsured depositors and creditors may have to wait for years before they receive any payments from the FDIC, and they may not recover all of their money. This highlights the importance of depositor protection and the role of FDIC in ensuring the stability and resilience of the banking sector, as well as the need to caution and due diligence in the face of uncertainty. This resulted in a withdrawal of funds from these banks or the selling of shares in these banks, putting immense pressure on their funding sources and market values. Banks such as Signature Bank, First Republic Bank, and City National Bank were among those affected by this flight of capital. In search of a safer haven for their funds, many depositors and investors turned to larger banks with more diversified businesses and stronger capital positions. They also sought refuge in safer assets such as US Treasuries and gold, causing an increase in demand and price for these assets. The collapse of SVB Bank was a wake-up call that revealed the regulatory gaps and weaknesses in the banking system. The bank's failure raised questions about the adequacy of capital requirements, liquidity standards, stress tests, supervision, and resolution mechanisms for banks that serve niche markets or have concentrated exposures. This sparked investigations by the SEC and DOJ into potential insider trading by SVB executives who sold stock prior to the bank's failure. SVB's collapse shed a light on accountability and oversight of the banking system and its participants, highlighting the flaws and loopholes in existing regulations and enforcement. The bank's failure brought forth both suspicions and allegations of misconduct and wrongdoing by its executives and advisors, further eroding the confidence of depositors and investors. One of the regulatory issues that emerged from SVB's collapse was the inadequacy of capital requirements. SVB held low capital ratio compared to other banks, making it vulnerable to shocks and losses. This sparked criticism that the bank benefited from a 2018 regulatory rollback that reduced capital requirements for regional banks with under $250 billion in assets. Another issue was the inadequacy of liquidity standards. SVB held a low liquidity ratio compared to other banks, making it unable to cope with a bank run. Critics argued that the bank relied too heavily on uninsured deposits of a source of funding, increasing its liquidity risk. The stress tests were also under scrutiny, as they were deemed not realistic or rigorous enough to capture the SVB's unique risks and exposures. Despite passing its latest stress test in June of 2022, critics argue that the test was not stringent enough to accurately assess the bank's preparedness for potential crisis. The supervision and resolution processes also came under fire, with critics arguing that regulators failed to detect or address SVB's problems in time or lacked adequate tools or powers to deal with them. They also called for the invocation of Special Resolution Authority, which would allow regulators to take over failing banks and sell their assets or operations quickly. Finally, the SEC and DOJ investigations into possible insider trading by SVB executives and possible conflicts of interest by Goldman Sachs Group Inc. added to the regulatory issues exposed by SVB's collapse. These investigations raised questions about the integrity of the financial markets and the accountability of its participants. So there you have it, folks. The fall of the Silicon Valley Bank has brought to light some of the most complex and pressuring issues facing the global banking system. If you want to stay informed and up to date on latest developments in finance, be sure to like, share, and subscribe to our channel. We will continue to bring you insightful and thought-provoking content that will keep you on the cutting edge of finance. Who knows what other exciting and revealing stories await for us in the world of finance? Stay tuned to find out, and as always, thank you for watching.